Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M by 1M, as you know, is the first and only global virtual accelerator for technology startups. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we do these roundtables week after week after week. These are mentoring sessions. These are working sessions. And this is our 376th session. Can you believe that? It's been going on for a long time, almost 10 years. And we've had the opportunity to work with tens of thousands of people. I mean, not hundreds of people or thousands of people, tens of thousands of people. So it's been really fascinating to hear what's happening in different parts of the world. And you will have a recording of the event available for later reference if you want to listen to it again or share with somebody. All the recordings of our roundtables are available on our YouTube channel, which is 1M Roundtables. And you'll also find other video content there. If you're live tweeting the show today, please use hashtag 1M1M. And our handles are at 1M1M and at Romana. We publish a ton of really interesting material on entrepreneurship, learning, and so forth. And I know a lot of people are learning from the content that we publish because I constantly get emails from them, all over social media, et cetera, et cetera. So, it's very helpful actually to get those positive reinforcements of that you're finding our content useful, because that, that gives us that feedback on that what we are publishing is resonating with you. So these are the call-in instructions. We're not quite ready for call-in yet. I will put these up later, but do plan on participating in the program today. This is a roundtable. It's not a broadcast. We will have some presentations, of course, and some, mentoring, but we also want everybody in the room to participate. So start participating in the public chat by turning your chat to send to all participants, and then we'll open up the lines a bit later so you can dial in and participate as well. We're going to start with a conversation with Ashmeet Sidana of Engineering Capital. Ashmeet calls himself a chief engineer. He is a brilliant engineer, no question about it, but he is running a venture capital fund for seed stage ventures that are deeply technical, solving deeply technical problems. And he's one of the few venture capitalists out there who can deal with very deep technical stuff. And I love that capacity in him. I like to refer our entrepreneurs to him. So today we're going to start with a presentation from Ashmeet. He wants to teach you a few things on market sizing. So I invited him to do that on this forum. So over to you, Ashmeet, and welcome.
Thank you, Shramana. It's a pleasure to be back over here. And I do enjoy very technical investing, and I am an engineer, as you said. But today I'm going to talk about market size from a general venture capital perspective. This should be applicable to all companies. There's nothing specifically technical about my presentation today. And I'd like to start my conversation on market size by telling you a true story from 1980. If you look back at 1980, I'm not able to move the slide here, so
I will move them. Just tell me when you want me to move them, I'll move them.
Okay, if you could go to the next slide, please. In 1980, AT&T was the largest phone company in the world. They were actually a monopoly, and telephones often looked like this. And in fact, there were no cell phones in the world. All telephones were landline phones. And AT&T, because they had been so successful and were so financially lucrative, had been investing in this technology for cell phones. They thought, wouldn't it be cool if you could have a phone that was not connected to a wire to a wall? And since 1948, as a part of Bell Labs research, one of the most fabulous research organizations in the world, they actually own all the patents for cell communication, going all the way back to information theory and Shannon, who won a Nobel Prize for his work. And so they decided to commission a study on market size to say, how big is this market for cell phones? Since, we are planning to build this cool new technology. And they hired a very well-known firm, McKinsey, to whom they paid $20 million in consulting fees to estimate the size for the market for cell phones over the next 20 years. In other words, by the year 2000, how many cell phones will the world need? Next slide, please. Here's what McKinsey came back with. In 1980, McKinsey's estimate for the worldwide market for cell phones, 900,000. In other words, less than 1 million cell phones. As we know now, McKinsey, of course, was wrong. In fact, they were very wrong. In the year 2000, the actual number of cell phones in the world was about 150 million. So they were wrong by 10,000%. And today, in fact, that market has continued to grow. We have almost 2 billion cell phones still continuing to grow. So you can see an error of 100,000% being made by McKinsey. And this error was not cost-free. Because McKinsey made this mistake and because AT&T believed this was the market size, they actually discontinued investing in R&D. They sold off all their patents and shut down their cell phone division. That was a very costly mistake. They realized their mistake, eventually buying back Macaw Cellular, which became the pioneer in the cell phone market, for $12.5 billion because AT&T realized that they had to go back into the cell phone market. Next slide, please. And just in case you're thinking this was a one-off error by AT&T or by McKinsey, here is an extract from the New York Times from 1992, which quotes Andy Grove, who was the founder and CEO of Intel Corporation. At that time, he was the chairman, who says, quote, "The idea of a wireless personal communicator in every pocket is a pipe dream driven by greed." So as you can see, most people did not believe that the cell phone market was going to be large. This became a very, very expensive error for AT&T, and many fortunes were created because of it. And so the first takeaway I have for you on market size, next slide please, is that getting your market size is really important. If you're an entrepreneur or you're a venture capitalist who's working at an early stage in a market, it's really, really important that you get it right. Otherwise, it could be a very costly mistake for you. Next slide, please. To make the next point on market size, I would like to talk about the same time period when there was another company, Motorola, also a Fortune 500 company, which also had very nice wireless technology. In fact, in the Second World War, they had pioneered the use of radio communicators, which soldiers used in their backpacks. And the name Motorola itself comes from the combination of two words, motor, Victrola, because they were the original company which had put radios in cars for the very first time to provide music in the 30s. And so they had fabulous they had fabulous wireless technology themselves, and they were also trying to come up with an estimate of market size for cell phones, because they thought, wouldn't it be cool if we could use our wireless expertise, we can learn the telephone side of it, and we could build an entirely new market. And so they commissioned a study internally, and now we have access to those internal documents, and we actually know that their internal estimate for the market size for cell phones was about 100 million, remarkably close to what turned out to be the actual number. And so the executives at Motorola got very excited and said, you know, this is a giant market, we have a technical advantage, and they decided to undertake the largest private R&D project in the world at approximately the same time that AT&T was deciding to stop investing in the cell phone market. And so they commissioned a project which eventually became called Iridium, a slightly different approach. It was a satellite-based approach to providing cell phone coverage, but arguably a much more superior approach because it was based on satellites. There was no regulatory constraints. They could provide worldwide coverage. There was no need to do roaming. It was a much better approach in terms of, you know, just if you look at it on a clean sheet of paper. And so they bet their entire company on it. Next slide, please. And here's what happened to Iridium. One of the largest tech failures ever. In fact, it was such a big failure because eventually Motorola ended up, you know, originally estimating it was going to be a $1 billion project, became a $5 billion project, and then they took more debt to try and make the entire project work. And the technology actually worked. Iridium phones did work. They were very reliable. They could work anywhere around the world. So it was not a technical failure. However, at the peak, Iridium only had 10,000 subscribers. That's the maximum they could get to, and it was such a big failure that the company Motorola ended up having to declare bankruptcy, and in fact does not exist today in the form that it existed earlier. There are parts of Motorola that got sold off to Google, and there are sort of other pieces that you see all around. So the second point I'd like to make about market size, next slide please, is that subtle product differences can make a huge difference in market size. And so when you evaluate market size, it's very important to do that in the context of the actual product that you are building, and understanding those differences can be a make or break decision when you do that. Next slide, please. So with that background, let me give you some views on market size. The reason market size is so important is because it is a fundamental limit on the size of a company. A company can never be larger than the size of its market. And so it's really important to understand it in that context if you're an entrepreneur or a VC looking at market size. And then the other point I want to make is that there are many ways of measuring market size. You know, people will refer sometimes to TAM, total available market, or TSM, total served market, serviceable available market. For the purposes of the conversation today, I'm going to ignore all these differences. These obviously matter if you're actually doing a study. But just to give you the concept, I'm going to ignore these differences. And lastly, everything that I say after now in this presentation is from the particular perspective of a venture capitalist. In other words, there are views of market size which have other applications, for example, to macroeconomics or political science, etc., which I'm going to ignore. So I'm going to give you a biased view of market size, which is how should an entrepreneur who is going into a new market think about market size. So from that perspective, let's see how do we measure market size. Next slide, please. There are two ways to measure market size, traditionally, top-down and bottoms-up. Next slide, please. Top-down is the most common view. You've often seen this. You'll probably hear this if you went on CNBC or CNN or read the Wall Street Journal. These are views of market size typically developed by extrapolating trends. You attempt to categorize events, and you may see reports, for example, published by Gartner or IDC, which says that, we think that the size of the security market for software is going to be so much, or IT budgets are increasing by so much. Here is a slide that I actually took from a presentation that an entrepreneur once made to me. I've deleted the name of the entrepreneur, of course, who's trying to estimate the size for software in the industrial automation market. And so it's a $75 billion market. They've categorized into several sub-segments, and each of those segments is a few $billion, and they're going to attempt to obviously go after some of these segments. So the question arises, if you are an entrepreneur, when should you use a top-down market size? Here's my view of when you should use it. Never. A top-down market size is completely useless from the perspective of an entrepreneur or an early-stage venture capitalist. Next slide, please. The reason I'm so dismissive of top-down market sizes, even though they are so popular, and like I said, you will often see them quoted in the press, you will see them, people talk about them publicly, is because if you are genuinely going after a new market, the analyst report that you are quoting should not exist. There should not be a study. If it is a disruptive technology, if it is a disruption that you are going to create in the market. More importantly, these reports are always based on some macro trend. They are making some observation on a very large class of consumers, customers, products, demographics, etc., which may not capture the specific micro value proposition that your product has to capture to get those initial customers to start building a scalable company. So it's really important to be careful if when you look at a top-down market size, it is something which is very hard to disagree with. These are often true, they are accurate, they may have application, for example, to political science, or they may have application if you're a macroeconomist, but to an entrepreneur, they are really useless. I don't think you can learn anything by knowing that the size of the security market is going to increase, or the fact that there are 1 billion consumers in China, and because you want to enter into the Chinese market. So be very careful when you study a top-down market size if you are thinking about a genuine disruption and building a new market. Next slide, please. And so what I recommend for entrepreneurs is to always take a bottoms-up market size. A bottoms-up market size is very simple. It is simply estimating how many customers you have and how many dollars that customer could give you. And the product of that is your market size. It's a very simple formula. You'll never forget this now. You don't have to write it down. So why am I so adamant that this is the right way to think about market size for an entrepreneur? Let's take a very simple example. Next slide, please. Here are the actual market sizes for the iPhone, which of course was the first really broadly successful smartphone introduced by Apple. So the iPhone first sold in the fourth quarter of 2007. And famously, of course, they only sold it through AT&T. Steve Jobs made a deal with them, and they sold 1.1 million phones in that very first quarter. And so if you apply this formula, the market size, using roughly $500 for a telephone, gives you a market size of about $500 million a quarter or $2 billion a quarter in Q4 of 2007. Now fast forward to Q1 of 2016, and the smartphone market, of course, has exploded. The market is continuing to increase very rapidly. Samsung has jumped in as the largest seller at this point. iPhone still controls the top end of the market. They have about a 15% penetration. We're selling about 1.5 billion phones a year at this point at an average price of about roughly $600 a phone. And so now the market size for the iPhone is approximately $30 billion a quarter, or about, in rough math, $100 billion a year. Obviously, the market has grown dramatically. So this bottoms-up market size is a very useful tool. And to give you a sense for that, next slide, please, I'd like to ask you a question. How many customers does Apple have? Now, in an interactive forum, I would actually ask you this question, so try and answer this question for yourself. In Q4 of 2007, how many customers did Apple have? Versus in Q1 of 2016, how many customers did Apple have? The answer is on the slide in front of you. And so if you had a chance or a moment to think about it, let me give you the answer. It is not what you may have guessed initially in Q4 of 2007, 1.1 million phones. That is not the right answer. In Q4 of 2007, Apple only had one customer. All iPhones were sold through AT&T, and in reality, Apple had made a deal with AT&T to sell all their phones. You had to go to an AT&T store or buy it through AT&T. You could not actually walk into an Apple store and buy an iPhone. And so very important to understand that Apple only had one customer. So how many salespeople do you think Apple had selling iPhones in Q4 of 2007? They only had one, and his name was Steve Jobs. This becomes obvious to you simply by looking at this market size of iPhone from a bottoms up. So there are many insights that are very important and very valuable to an entrepreneur that become obvious if you actually build a bottoms up market size for your product. Next slide, please. So what are some of these advantages of a bottoms up market size? A bottoms up market size forces you to focus on an individual customer. This is critical. What is the price they're going to pay? How do you reach them? What is the value proposition to them? What are the benefits, disadvantages? What is the competition to that single individual customer, how they will perceive it? Obviously, in the case of Apple and the iPhone, AT&T was the laggard. At that time, Verizon was the largest cell phone provider in the US, and AT&T used the exclusive deal that they got from Apple to vault themselves to be the #1 provider of cell phones in the US. So there are many advantages of looking at it from a bottoms-up perspective. A second advantage, you can easily test your assumptions about your product. Because you are looking at an individual customer, as I gave you on the previous slide, the example, you know how many salespeople Apple had versus how many salespeople Apple has today when they are selling many iPhones. They still continue to sell them through AT&T, Verizon, etc., but also through their stores. And so you can easily test your assumptions, and you can make a real budget. You can operationalize a budget if you have a bottoms-up market size. So I'll summarize it by saying top-down versus bottoms-up. Always look at it bottoms-up if you are a new entrepreneur. You can go back to a top-down market size if you want to reconfirm or validate something in your assumptions, but always start from a bottoms-up market size. So with that, next slide, please. Next slide, please.
You want this one or another one?
Yeah, this slide. Thank you. I'd like to make two more points on market size, and the first of those points is really the difference between precision versus accuracy. So the question arises, when I ask you to estimate the market size from a bottoms-up perspective, how much should you focus on precision, or how accurate do you have to be on it? For those of you who are engineers, this will be obvious, and you can skip the next 30 seconds. But for those of you who are not, here's a very quick description of the difference between precision and accuracy. Precision is how repeatable a measurement is. Accuracy is how close are you to the actual underlying value that you're trying to measure. So here's an example from pi. We all know pi, of course, is an irrational number. It's equal to 3.14159, et cetera, et cetera. And if I was to tell you that my estimate for pi is 2.1415, that would be a more precise estimate. And if I was to tell you that my estimate for pi is 3, that would be a more accurate estimate. And to make this distinction on market size, I'm going to give you a real case study. Next slide, please. And so here we have a real case study on the market size for YouTube. We are fortunate to have the original emails that Sequoia Capital, which is a very nice venture capital firm, had used to discuss the market size internally of YouTube before they made the investment in YouTube. And these emails became part of a public record. Mind you, these were confidential emails when they were discussing them. These became part of public record because of a lawsuit between Viacom and Google after YouTube was sold. And so what I have for you here are the actual emails from the deposition of Roloff Botha, who was the partner who had led the investment and served on the board of YouTube. So here's what Roloff writes in his emails. Next slide, please. Here, Roloff is making the argument on what is going to be the market size for YouTube, and he says he believes user-generated video content will explode. That is the underlying premise on the basis of which he's going to estimate the market size. Remember, when Sequoia invested in YouTube, it was a seed investment. The original request from YouTube was to raise $1 million in a seed round. Eventually, Sequoia ended up investing $3 million, but that's because, the company was growing pretty rapidly. But in any case, the original presentation from YouTube did not have a market size discussion in it. And so the partners internally are discussing it. And this is an actual email from Roloff to Mike Moritz, who at that time was running Sequoia Capital. And so he's making the argument that user-generated video content will explode, and he creates his own estimate of what that market size will be. Next slide, please. And here's Roloff's estimate internal to Sequoia of what the market size will be. He says, here's a scenario where they serve 10 million videos a day at an average price of $10 per 1,000 ads, of which they've sold only 15% of their inventory, and they would then have revenues of about $6 million. And then he gives another scenario of $55 million. Notice he hasn't actually given a time frame for this, but the important point on this slide is to note that within their internal estimate, even when they were making the investment, there was a 10x difference on what they thought the market size for YouTube could be. Now, of course, they were wrong. The market size is much, much, much larger. YouTube is doing about $5 billion in revenues now for Google. But the important thing to note is that they got the direction right. They were accurate. They were not precise, but they were accurate in the direction that they were going for. And it was large enough that they felt it could be a venture-backed outcome, and that's why they went for it. And so that's the point I wanted to make with this case study on YouTube. Next slide, please. Which is that you can ignore precision if you are an entrepreneur. You need to get the approximate sense of what the market is, and if it is big enough and if you are disruptive enough, that will be good enough for you to build a company. To make the last point on market size, next slide, please. I'd like to do a quick case study on Uber. This, of course, is a current company. It's a very interesting case study because this company is still private, and so there are still arguments about what is going to be the market size for Uber. And so next slide, please. This company has been studied by many people, including Professor Damodaran, who is a professor at the Stern School of Business in New York. He's a very famous professor. He's known as the Dean of Valuations on Wall Street because he studies valuations and market sizes for companies. And so he published a case study on Uber, a detailed case study where he estimated all the possible markets. He did a very careful study between, important cities like New York, Tokyo, et cetera, and then at a country level, in which he estimated various scenarios. Bottom line, he estimated that the maximum valuation, the risk-adjusted valuation for Uber should be roughly $5.9 billion, which was based on a worldwide estimate of the market size for $100 billion. Well, right after he published this case study, next slide, please. This headline caught my eye. Uber may be nearing a $70 billion valuation with yet another $1 billion funding. In other words, someone was going to write a $1 billion check into Uber at a $70 billion valuation. Clearly, this person who wrote this check disagreed with Professor Damodaran on what should be the market size for Uber. Otherwise, they would not invest at such a high valuation. And so shortly after this happened, there was another case study published by, next slide, please. Sorry, before I go to the other case study, I should mention that when this Upstart article came out, Aaron Levy, who's the CEO of Box, sent out one of the best tweets, in my opinion, on market size, where he said, quote, "Sizing the market for a disruptor based on an incumbent's market is like sizing the car industry based on how many horses there were in 1910. Obviously, in the early 1900s, cars became very, very important in the market, and the market size for cars should not have been determined off of how many horses people were using before that. And so this is one of the really, in my opinion, all-time best tweets on market size. And similarly, in this notion, there was a case study published by, next slide, please, by Bill Gurley, who is one of the co-founders of Benchmark Capital. At that time, he was on the board of Uber and is a very early investor in Uber. And so he makes the point that when you study the market size as a VC, you have to think about market expansion. In other words, what are the new use cases that will occur other than for what the incumbent was being used for? And he gives some examples over here for which Uber may be used where a taxi may not have been used in the past. For example, use in less urban areas or as an alternative to rental cars. And then the last one he makes, the very important point, which is an alternative to car ownership. And so based on that, he published his own study. He published different scenarios, different use cases, different penetration rates. And bottom line, he came up with an estimate for the market size for Uber of $1,350 billion. In other words, $1.3 trillion. Obviously, very different from the market size that Professor Damodaran came up with. So next slide, please. So as you can see, with the same company studying the same data at the same time, people have wildly different estimates for what is the market size for a company like Uber. In this case, one person making the estimate of a market size of an incumbent market and the other person making an estimate off of what will be the market expansion. Market expansion is obviously an estimate. It's a projection. It's an opinion of what it will be. And so you would come to your own opinion as you study your market as an entrepreneur on what you believe will be the market size for it. And so the last point I'd like to make about market size, next slide please, is that market size is in the eye of the beholder. You have to have your own opinion of what your market is, why it will be there, and of course truth will be decided based on whether you're right or wrong. That's really what companies live and die by. So that's my presentation on market size. I've gone quickly through this, but I am going to stay on, and I'm happy to answer more questions about market size or venture capital in general as we go towards the end of the presentation here after we have the pitches. I'll end by saying that, next slide please. This is my last slide. I run a venture capital firm called Engineering Capital. I invest at very early stages. Shramana mentioned that I focus mostly on technical entrepreneurs in the IT infrastructure space. And I put this ad up on my website to highlight how difficult the journey can be for entrepreneurs sometimes. It is a difficult journey, but you can have a massive impact if you can build a successful company. So happy to answer questions related to market size, IT infrastructure in specific, or more generally about venture capital in general as we move forward. That's my presentation. Thank you.
So, folks, what Ashmeet said about market sizing is 100% what we practice in the 1M1M program. We completely ignore top-down TAM and completely focus on bottom-up TAM. And if you look at what we do in the premium program, a huge amount of our time and energy goes into helping people figure out their market sizes. I would say inevitably, people get market sizing wrong. There are very few entrepreneurs who come to us with a clear model that they can defend and stand by. And it doesn't need to be precise, but it does need to be accurate, it needs to be directionally accurate, but very, very often we see glaring errors in assumptions, overestimation, and occasionally underestimation. So everything that you've heard in this presentation today, we stand by and we encourage you to follow in your own analysis of how big an opportunity you are working on. And frankly, this is TAM, market size, is the driver of whether you have a venture scale company or not. If your market size is like a $50 million market, that is not typically a venture scale company. And it's okay to build that company nonetheless. We're also big believers in niche businesses, and you can build a $5 million, $10 million company, and a profitable $5 million, $10 million company is a fine success story, but this is not the kind of company venture capitalists are looking to invest in. And you have to internalize this fact. Not all businesses deserve to be venture funded. That doesn't mean not all businesses deserve to be built. There are a lot of companies that deserve to be built that do not deserve to be venture funded. So anyway, I'm going to move us to the next segment of the session, which is the entrepreneur pitches. We have 3 pitches today. Just a little bit of expectation setting here. We want you to succeed. This is a working session, 100% focused on helping you move a little bit further forward in your journey, help put a few steps ahead of each other so that you can accelerate your process slightly. It is very possible that you may disagree with the feedback Ashmeet and I give you today, and that's okay. It's your venture eventually. So you have to make choices, you have to make decisions, and you have to define your own strategy. Of course, as I said, not all businesses can raise money, not all businesses should raise money, and raising money doesn't guarantee success. There are lots of stories in venture capital where people have raised substantial venture capital, $20, $30 million of venture capital, and then failed. Why? Because hypergrowth, which venture capital is predicated upon, the model of venture capital is predicated upon, is not a natural state. Just by putting $20 million into a company, you cannot guarantee hypergrowth. The market has to accept your product and want your product at a really accelerated pace for you to be able to deliver hypergrowth in a business. And if you can't do that, there is no way you should raise venture capital. But venture capitalists also make mistakes because, remember, we're all working with imperfect information. Entrepreneurs are working with imperfect information. Venture capitalists are working with imperfect information. We are working with imperfect information. So we make assumptions. We define models based on assumptions. We make bets, and not all bets pan out. That's the nature of the business we are in. The startup business is, at the end of the day, a business of taking risks. Calculated risks, hopefully, but not necessarily, it's not a risk-free business at all. We're going to go to Krishna Guda as the first presenter. Krishna, please unmute your line and tell us what you're working on.
Great, thank you. Good morning, Shamna and Ashmeet. Thank you for that wonderful introduction. I might have to review some of my slides after that, but we come back to that then. End for the session. I introduce myself first. My name is Krishna Guda. I'm an investor advisor with a very unique, innovative IoT services company called M2M One, based out of New Zealand. So I'm a little bit further away from most of the others on this call. We target SMEs, and I come back to that as being our target market segment, and within that a specific set of verticals. Our whole sense of purpose, which we set up this company for, is to make it easy for SMEs to use IoT and focus on using the IoT to benefit their business rather than the complexity of setting up an IoT solution. So we want to take away that complexity and make it easy for them to implement their solution. I have worked in the telecom sector, and thank you for introducing the AT&T views. I've been with a telecom vendor for more than 20 years, and we've enjoyed the benefit of owning some of those IPs that AT&T sold. So we're happy with that, Ashmeet. So it's good to see that we can grow with that. The team that works directly on this venture are all from the tech and IT sectors, have been involved with telecoms in hardware as well as in the software and sales of IoT solutions while they were at the telecom vendor. And we set out to sort of work with, the companies in that space. This next slide is mainly about the market. I don't want to delve into this except to share a few key messages. One, New Zealand is a country, and this is based on a report done by a government agency looking at what IoT could bring to the New Zealand economy. The IT tech sector in New Zealand is one of the fastest growing, contributes more than 16% of the New Zealand economy, and the government's keen to continue to grow it. They see IoT as being an enabler, and as it says there, New Zealand is ready for IoT in terms of positioning. The numbers there are numbers. I want to go straight through to where we stand in that value chain of IoT. And for us, we see 3-4 different players. I'll sort of spend a bit of time on this slide just to explain our sense of purpose and where we belong. We see the device providers, a network connectivity provider, the actual platform or app and analytics providers, as well as the customers. And traditionally, SMEs, not maybe just in New Zealand, but anywhere in the world, are usually the ones that struggle to connect all the dots across these 4 different elements in the IoT flow. And what we have said and learned, we've been running an operation for 1.5 years now. We've learned that helping them get across the barriers of working with these 4 different players is the key. The foundation of our business is we are a reseller, if you use the word, or a customer of one of the larger mobile operators in New Zealand, where we resell their data SIM cards. We have a multi-year agreement with them, where we are supposedly their exclusive reseller to the SME segment of the data SIM cards. We take that exclusivity word very loosely, but more importantly, they retail their offerings to the SMEs through a channel of hubs, and the hubs are instructed to come to us as the provider of the data connectivity if an SME is looking for a data SIM card or a data sensor. So we feel we have a fantastic go-to-market. We have some 29 hubs across the country that will sell our data SIM card and our data connectivity. In parallel, we've engaged with a number of the app providers. We are strategic partners in specific segments. And our positioning we have taken is we provide the SIM card, we help you manage it, that's our USP, but we really enable an end-to-end for the customer an ability to use an app. So we bring the app provider, the analytics, and the information they want to collect and how they use it and help them set it up. So the service piece is where we want to play as an end-to-end driver of the ecosystem for our customers. The arrangement with the customers is we build them, we work with them, and if you move to the next slide, probably briefly talk about where we actually add value to them initially in the connectivity space. A lot of the SMEs struggle to manage their data usage, as simple as that. They end up with humongous bills of overages, and we have managed with our platform to help them get very good visibility of what they do with their data usage. The activations, we do it over the air. We send them the SIM card. We help them with the setup of the activations, and we provide them some very good reporting that they lack from the operators themselves. So that really gives them confidence that they're able to control and manage their connectivity piece. And then we step forward by saying, if you look at specific solutions you need, then we are able to help you with an application partner that can deliver that solution, and we will help you implement that. So that's the way we play, and we've learned over the last year that SMEs love us for that. They really are keen to see that we can help them engage and help them actually use the solutions that we bring to the table. Where are we at now? Just a quick summary. We have also learned that to try and address the broader market in general is a difficult task. We have focused in on 3 key verticals. Agriculture, again, the number of SMEs in this space in New Zealand is huge. The primary industry is the largest industry. So we are looking at how to benefit, the primary industry.
Can you mute whoever is generating this noise?
Sorry, yeah, I continue. Yeah, so we have 4 key segments we're working with. We've pinned them down and we've become sort of the experts, if you call, in those areas. Smart agriculture, we forget the word smart, but basically primary industries. We have built strategic partners across each of these areas. New Point, for example, provides specific application and software for supporting the logistics of some of the pre-ag requirements. We have looked at logistics in general, telematics, and security, with not from a general security point of view, but from a specific video and video compression security capability using a specific algorithm that we're working with, and in general smart cities. This links into the study of where the growth is in New Zealand, but we have pinned down these areas as being the 4 segments we will work in, and we are building a reputation in that area over the last year. In the last year, we've actually sold 10,000 SIM cards already. We have 200 odd fully billing customers where we bill them directly. We have 300 active leads further. And one big catalyst that has changed is, though the SMEs are the segment that we will target, the operator that we work with sells directly to the larger corporates. They had 3,500 direct customers. Most recently, they've actually moved half of that base through to their hubs. So about an additional 1,800 enterprises are available for us to address as a target market. Within those specific 1,800 enterprises, we see about 60–70% of them fall into our 4 key segments. So the real driver for us for this pitch is, we see now, if I move to the sort of next slide, Shamanan, we see now that we have done well enough to position ourselves in the market. We see that there is a catalyst from the government to really drive IoT further within, and there will be a lot of initiatives on that front. We also see that with this addition of the 1,800 enterprise customers that we will be able to target, we now need to move much faster to sort of grow with the growth that we see in the market space. I do have some numbers around how we arrived at our target market, and these numbers, they are probably, hopefully accurate, not just precise. Our thinking is the following: there are about 160,000 SMEs in the New Zealand market. We can target at least 40% of those, and we believe we want to get a 10% market share. And we have seen in our experience over the 10,000 SIMs we have sold, on average, we get 20 to 30 connections for each customer. So we're targeting to grow across the SME space and this additional 1,800 customer base that's going to be addressed, move from 300 odd customers we have now to about a 2,000 customer base over the next 3 years. And that reflects in the numbers that we have on the slide of the actual connectivity that we see. Just moving to the last slide that I have, and then I have a couple of questions. So what we're looking for is, because we have been bootstrapping ourselves as a company so far, we haven't really looked for outside funding. We have said now is the time to really see what we need to do to accelerate the growth, especially around the enterprise opportunity, and really see how best we can do that with either a strategic sort of partner who comes in with another specific application or a provider of an IoT service from any part of the world, or a pure-fledged financial investor, as long as they're confident that we have the capability to reach those 2,000 customers over the years. So our summary is the drivers for that investment request is the market is in this growth mode now and entering it. We see the catalyst. We see the same sort of growth rate from the GSM and the cell phone markets in the way it started in New Zealand. We have the comparisons for that. We have trained those hubs from the operator. They're ready to sell on our behalf, and we have this new target base that we want to address. So the timing is now for us to grow. If we continue to bootstrap, we will sort of miss the window of growth over the next 2 years that we want to hit. Where we want to invest that money is to build a team.
Let's switch to discussions.
Yes, please. I had a last slide on questions, so you can click to that, and then I would love to hear some feedback.
Do you want to say anything else?
No, I think that's questions itself. I think we can just go straight into discussion. Love to hear initial feedback, and then how, and there are a lot more information, of course, behind these slides.
So my questions, and you can select my questions and Ashmeet's question, and some of it probably will overlap, and then you can answer them as in whatever sequence that pleases you. My question, first and foremost, is your primary product these SIM cards? That's what you call Internet of Things, and you're finding IoT use cases in these 4 verticals where you are selling these SIM cards. Is that the primary business, or is there other pieces to this puzzle? And this is a question vis-a-vis business model. What is,
correct, yeah.
What are you selling? Is it just those SIM cards, or are there services around that as well?
Good. I think the SIM cards are the primary foundation, but what we are actually selling is the services around that. In our mix, we have assumed that it's probably 80% still SIM card. We believe, though, the services business will grow based on what the customers have been asking us. Just to give you an example, we might sell 10 SIM cards to a farmer, but he's happy to pay us $200 to come and help set it up remotely or even on the ground. And we are seeing that continue to be a growth area for us. That wasn't in the original plan. So SIM card is the foundation. We'll make our bread and butter on it, but the cream is the services that we can provide.
But if you don't provide those services, can you scale? Can people actually, these farmers are not people who can install IoT, right?
Not really. So we see the services as being an important component of it. Some of the offerings that we have are pretty straightforward. We deliver the hardware and the SIM card embedded in it, and then they're able to just switch. It's plug and play. But there are a lot of applications that they cannot use simple plug and play services, and that's where we believe the growth will come on the services front. We have been conservative on that, though.
So the reason I'm probing this point is that I see that level of services as a deterrent to growth. Unless there is a network of service providers, system integrators who operate in those markets that you're targeting, who can take over from you and actually make the services revenue while you focus on products. Typically, investors tend to dislike the model of having to set up a huge services infrastructure out there. So that's one feedback that I have. The second
correct.
Feedback is I have not seen that bottom-up TAM analysis of this business, which is a requirement for me to make any conclusion whether this is of interest to VCs or not. Ashmeet, what about you? What are your observations?
So, Shamana, I agree with the line of questioning you started with. The feedback I would have for the entrepreneur is that it was not obvious to me what your product is at the end of your presentation. And so you really need to sharpen the way in which you describe what you are selling. Is it the SIM card? Is it the services? What is the relative importance of those? And if services is really the cream, then give an example of a service and what would, why that would grow. And if the SIM card is the important thing, then what is your differentiation or
the differentiation? I really didn't get any sense of that differentiation.
Right, exactly. So what will allow you to continue to grow and become a large business if you are beholden to the underlying cellular service provider? I assume these are cellular SIM cards. So to the underlying cellular providers. In other words, are you just a distribution company? Are you a software company which is doing something with distribution? Or is there some technology innovation that you've done? I would say you really need to sharpen that distinction in your presentation.
Fair enough. Absolutely. I'll let you continue if you have the questions. I might just come back and give you some feedback, and then I think
Krishna,
take all that on board.
We're going to have to, we have 2 other presenters, so we've already spent 20 minutes on you, so we can come back during open Q&A later. There are questions for you in the public chat as well. So people in the public chat, ask away your questions, and Krishna, I hope you engage with the group in the public chat. While we listen to the other 2 pitches, David Villan from Madrid is next. David, are you ready? Maureen, where is David? David, you need to unmute your line. I see you on the panel. Should I move on to Ignacio? All right, we'll come back to David if he dials in. So here we go. Ignacio, I'm going to your slides. Ignacio, please unmute your line.
Sure, I'm here.
All right, go for it. How did we get 2 Spaniards in this call?
No, 2 people
That's
from
not
Madrid
usual.
even. We're from the same city. I'm
Are you from Madrid as well? All
yeah.
right. Okay, tell us what you're working on.
Okay, we're working on WishU, and WishU, as you have seen or you will see in a minute, is the evolution of the greeting card. We created what we wanted to call the social greeting card, and it's something that every time we show it around, everybody says that hasn't been invented yet, and we're like, no, we're the first ones that do this, and it's basically a card that you can share with a lot of people, sharing the same place to put handwritten dedications, to add voice contributions, and even monetary contributions to a gift. So we try to make the real substitute of a greeting card, of a paper greeting card. This has been something that the greeting cards have been there forever, and it's been a market that is very, very difficult to disrupt. And we think it's difficult to disrupt because it has a lot of emotional value, right? When you receive a card, and you can still remember those cards that we received when we were kids, and you got that card from your best friend, and it was handmade, and it had that little doodle and stuff like that. So that emotional value of paper greeting cards is what has been sustaining this industry. It's not our estimation, but we got a couple of studies that we were talking about market size. They were sizing this market in $23 billion worldwide. So we said, how is this, industry hasn't been disrupted yet? And we tried to create this product that is a little bit, compound all these things that I mentioned. You can go to the next slide if you will. We saw statistics, and we were looking for statistics about, greeting cards in the paper format. And we came with those numbers that were very, very encouraging. Only 5% of people right now today, they keep their greeting cards, they keep their memories in a paper format. I have two girls, 5 and 9. They think they're 20 and 30, but and so they're social machines. We have every single weekend we have a birthday party, and it's always the same thing. And everybody that has kids can relate to this. Is running to the CVS, at least here in the United States, running to the CVS store, the last minute of the Target, grab the first card you get, sign it, put whatever in there, and making sure and being sure that card is going to be destroyed in the next, 2 hours or 3 hours or 3 days. So 7 billion paper cards we sold in the United States in 2015. And of course, the second part is a gift, and the gift goes with the card. And it's a very difficult thing sometimes to try to give the right gift. So there's considerably, like I said, waste of time in all these activities. And that's one of the things that we wanted to remedy. We wanted to have something that was shareable with a link, and then everybody can sign on their own phone with their own handwriting and keep those memories forever. I'll go to the next slide if you will. So this is the way it looks. It looks like that's my oldest. So this is used, of course, party venues like the Chuck E. Cheese, all these places that organize parties. Right now, let me see. Can you see me, by the way? Am I on camera?
No, you're not.
I'm not. Okay.
Your slides are on the screen. That's your primary.
Oh, okay, because I can see you. Okay, I was going to show you something that I want. Okay, so party venues is schools. We have a meeting with the school superintendent the other day that told us that for Teaching Appreciation Day, they wanted to make a card in every class for every teacher. 300,000 students, signing, thank you for the teacher, and we appreciate what you're doing. Hospitals, it's obvious, and I would show you if I have the chance here in my wall. I have a little bit of a test that we did with some wall decor. So every single of these signatures is a file, is a vector file that you can export and put in T-shirts, or in the case of the hospital, we put them on the wall. So there was a kid in the hospital that had the whole wall, full of dedications of, from her friends. Fundraising, they use also for hospitals. We're talking with the Girl Scouts right now of America, which is, 13 million kids. We're talking about with the YMCA and other institutions, because for them fundraising is very important, and our card can give them that edge in the fundraising, so people can write, and after they write, of course, they're presented with the possibility of doing some donations. With brands, we have the World Guinness record right now is of Nestle. Nestle has a card that has 40,000 signatures on it. If you go to the next slide. Again, schools, charities, hospitals. We have right now some celebrities that already use our card. The first one was Oprah. Oprah was the first celebrity that used our card. And, for the Festival of Cannes in May, there was the 70th anniversary of the Cannes Film Festival. And 44 Hollywood celebrities made a Wish You card, Clooney, Affleck, Foreman, Arnold Schwarzenegger. A lot of them, made a card on Wish You to celebrate the anniversary of the Cannes Film Festival.
How did Oprah find you, or how did the celebrities of Cannes find you?
Yeah, that's my secret. That's my secret formula. No, we have an agreement with the Hollywood Foreign Press Association. I know from my previous lives, I know a lot of people in entertainment. So I had an agreement with the Hollywood Foreign Press Association, and they were in Cannes. And now we have the Golden Globe card.
Because the reason I asked you that question is because that is a bit of, one thing you will see in our circles, the technology startup circles, is the use of a term called unfair advantage. And we're all looking for unfair advantages. And, anything you do, you have to somehow defend yourself in crowded markets. And any unfair advantage that you can play with, play this game with, gives you an edge. And what I notice here are certain unfair advantages that you are talking about. So I'm curious, where is that coming from? I like it.
We have right now, like I said, the Golden Globes is the 75th anniversary in January, and we already have that card on the way. We have more than 60 celebrities that already signed the card. And some of them, like Sofia Vergara and some others, we are right now in talks because they wanted to. They're pretty and they're talented, right? So now they want to be rich. I mean, not rich, they're rich already, but they want to be founders. And so because we have more than 20,000 users, our content is very snackable. I mean, you can go and browse dedication after dedication of these big cards. They're very interested in this. Our largest card right now.
But no revenue yet, though. What is the revenue model? I'm not yet where I understand what is this business. Is it a business?
Right. The business right now, when you create a card in With You, what you have is the possibility of putting a gift on that card. So the gift can be either a donation campaign, which is now very, very fashionable. You have your birthday, and especially for stars and for celebrities, they want to donate their birthday to a cause, like the Ice Bucket Challenge type of thing. But now you can choose also among 21 gift cards that we offer you. We have Amazon, we have Apple, we have Walmart. You name it, 21 of the biggest retailers are on our website. I mean, on our app right now, which is where you create cards and widgets.
You're an affiliate of these companies?
Yeah, we have a commission from them. We get a payload, a percentage of the payload from 10 all the way from 10% in some articles from Amazon to 3% with Visa and MasterCard. They give us 3% of the payload in any of these prepaid cards that we sell for them. So this is basically one of the revenue models that we have is that, of course, then they would come. We have others like coupons. So we're designing right now a way in which companies will give you a coupon or a present for your birthday. So we're talking with the Starbucks right now, trying to for Starbucks to say, okay, if it's your birthday, I will give you a coupon and you can go have a latte, half the price, or even, you know, giving you away a coffee. So all these, so the people that sign the card will be exposed to the brand, and the brand will be part of that board that you saw before with all the signatures, will be the brand of Starbucks all the time. So every time you
so your assumption, let me see if I can spit back what you're telling me, and see if I got it right, because this is one of the things. Again, you're going to need to work on your pitch. The pitch doesn't convey clearly, even after 10 minutes of chatting, what you're doing. So let's see if I can help you there. So it looks like you have these very specialized cards, and the people who are signing these cards to wish somebody on some occasion, whether it's, you know, get well soon or birthday or whatever, you expect they will also contribute some sort of a gift, whether it's a gift card or you know, Starbucks latte or whatever, and they're going to buy that through you, and you take a percentage commission on whatever commerce happens on your site. This is your business. Yes?
All right. Okay. So let me just clarify a little bit. Yeah, the person who creates the card, which is going to be, of course, you know, the mom, the dad, or your, you know, husband or wife, or, you know, whoever, your coworker. That person is the person that's going to say, okay, you know, Ignacio or whoever, you know, Samana wants a really cool, you know, mountain bike. And so instead of receiving 20 different meaningless gifts that you don't know if the person is going to like, we're going to all contribute to this gift. So everybody will contribute to the same gift. So this becomes a board in which everybody can you know, put the same dedication of the you know, their own signature, and a gift where everybody will contribute their money on that gift. So the person who creates the card decides whether it's a gift card or a bike, like I said, or some sort of donation.
So it's a gift pooling solution. This, by the way, gift pooling, I've seen many presentations over the years that we've been doing this. We've seen many presentations where people are building apps or websites to pool gifts. So that's not a new concept.
No, it's not. The co-gifting part is not a new concept at all, and it's, you know, it's a positive for us that it's not a new concept, because there's one less thing that we have to do that is new, right? So, but the person, when you create a wish you card, chances are you're not creating it because of the gift, but because of the board and because of the fact that everybody can come together in the same you know, board, in the same platform. So the gift is an added value to all that.
Ignacio, just a second. I'd like to get Ashmeet's points on your business. What are your thoughts, Ashmeet?
Yeah, the way I would, I'm sorry, go ahead.
Yeah, the way I would frame the question to you, Ignacio, is what is your barrier to entry? In other words, if you are successful in building this into, you know, you've clearly demonstrated some very interesting unfair advantages in getting access to celebrities, etc. If you are successful in building this up, what will stop someone else from coming in and copying you and building a large business?
Okay. I mean, one of the things that we have, and it's one of the bases for the patent that we have presented right now in Europe and the United States, is the fact that you can put voices together. I mean, one of the things that you can do, and maybe I didn't mention that before, but I should have, is that along with the card, you can make a chorus of voices. So you can say happy birthday to you, and then you will see people saying happy birthday to you. We have in their own phone, in their own devices. And we have an algorithm that does the voice alignment, the pitch correction, and these sound like a real chorus of voices saying happy birthday to you. Okay, this is the what our patent lawyer calls the golden nugget of our patent application.
But besides that, I think none of that is monetizable. Your monetization is a completely different strategy. Your differentiation and value proposition of these very customized cards with lots of voices and signatures and customization and input and all that, and celebrity endorsements and celebrity, you know, visibility, all that is one side of the story, but none of that monetizes. The monetization story is a gift pooling service, which has nothing to do with the former. That's what worries me about this business.
Yeah, well, like I said, you know, when you create a card, you have the option of adding a gift. you may decide not to add a gift. But you know,
but if the people do not add any gifts and use your system, if most of your people don't add any gifts, then you don't make any money.
Yeah, well, that's true, and like I said, you know, we always have, and we're pursuing the deals with with big players on these markets that I mentioned. We're talking about the second company after eBite. We're talking with you know, the Chuck E. Cheese. We're talking with all these brands that want this snackable content, and of course that's another source of revenue. If you ask me to measure that source of revenue, I have like no clue at all. But you know, I'll
just cut to the chase, Ignacio. My problem with your presentation is that I don't see a business here, and that worries me very much. So I think your idea of white labeling the system is maybe the beginning of a business. So if eBite is willing to pay you to, you know, license your system or OEM your system, that is more of a business to me. You know, let's say eBite or any of these other invitation companies are willing to pay you, and maybe there are many other types of companies you can think of maybe there are 50 companies out there of various kinds that are willing to white label your system for various purposes and are willing to pay you. That to me is a business. The consumer business is not a business. The consumer service is a free service, and in our worldview, a free service is not a business. And you will not be able to survive unless you have huge amounts of personal money that you're willing to subsidize this with. You're not going to survive.
No,
right. What I would add to that, Samana and Ignacio, is that there are companies whose business is to give away free services, which they monetize with advertising, and that is a big risk to you if this becomes a successful concept that people want to do. For example, Google can make a lot of money, and they have a lot of distribution where they could create a product like this, and they could monetize that much more efficiently than you would be able to. And that's why I asked you, what is your barrier to entry in terms of what will prevent someone else from, quote unquote, stealing your business away if you are successful in making this into a successful user concept? You really need to think carefully about how you will prevent that. Otherwise, you'll build a mountain and lose the mountain immediately after you've built it.
Yeah, this is something is always on our mind, right? I mean, the fact that barriers of entry today are, you know, are lower and lower in every type of business, unless we're talking about highly technical stuff. But when it comes to consumer products and to consumer consumables, is lower and lower. I mean, for us, the name of the game is trying to position our market in the market, you know, soon enough and well enough. And try to get, you know, these partnerships with these, you know, celebrities and alike, and make them even part of the company. That's what we're talking about with them, to create enough, you know, consumer mass so we'll become attractive. And we see ourselves becoming attractive to people like, you know, Hallmark American Greetings, which have a huge stake in continuing with the paper business, and they have, you know, many square footage of their products in the omni-channel and drugstores all over the country and pretty much, you know, all over the world, and becoming attractive for them because they've been buying out companies like us. Well, not like us, e-card companies, like the regular e-card that we all know, like from
So, Ignacio, I'm going to stop you there. As far as we are concerned, exit strategy is not a business model. What you're talking about is an exit strategy, not a business model. You need to figure out a business model so that you can work with customers, generate revenues, and an exit may or may not happen, but you cannot substitute a business model for an exit strategy, with an exit strategy. Okay?
All right. Thank you very much.
You're very welcome. So, folks, I'm going to spend 3 or 4 minutes, give you an overview of how to use the program, and then we'll go right back to Q&A. And Ashmeet is here, I'm here. So line up your questions. You can start typing in your questions in the public chat, and we'll spend around 20 minutes answering questions, okay? And if Ignacio or anybody else is interested in asking, Krishna, anybody is interested in asking questions further on your businesses, that you've presented, that's fine too, but this is now an open Q&A session, so all of you can ask questions. So quickly, while you're doing that, our request to you is if you like what we do here in 1 Million by 1 Million, recommend 10 serious entrepreneurs into the program. And the word serious is in bold, right? Why? Because there's certain types of entrepreneurs out there who have very different ideas about entrepreneurship than we do. We are, extremely, you have to work, you have to do tremendous amount of heavy lifting with no pay, and it's a real slog to build a company. We are of that school of thought. And there are entrepreneurs out there who have completely unrealistic expectations, that they expect that somebody is going to pay them, somebody is going to basically invest in their company for them to start developing their concept and so on and so forth. And none of this tallies with what's happening in the market and what the reality of the world of entrepreneurship is. Those are not the kind of entrepreneurs we're interested in working with. The other thing is, as you can see, the feedback is very, aggressive. Some of the feedback is all of the feedback is constructive criticism, but you have to have appetite for constructive criticism. You can't be defensive and reject feedback just because it threatens your worldview. I think good entrepreneurs, in our experience, good entrepreneurs are the ones who can take constructive criticism and plug the holes in their thought process. In your strategic plan, there are tons of holes. I can guarantee you, just because of the stage that you are in this 0 to 1 million or maybe even a little bit beyond stage, your business plans are full of holes. And it's our job to help you plug those holes. And today we spent a lot of time on TAM. TAM is a hole in most business plans. Bottom-up TAM is a hole in most business plans. So all of that is going to come up in these discussions and in the private roundtables for those of you who are part of the premium program. This is what we do, is plug the holes, work on your businesses. These are working sessions. All resources are at 1MBY1M.com. You will find a blog that is chock full of learning material. You have the Entrepreneur Journeys book series. There are 12 volumes of those. All are case study-based books, 12 to 16 case studies each. And that's, you get to double-click down on a variety of different topics that you can learn from those books. These roundtables happen every week. This is the 376th session. Our premium program is the full acceleration program. We offer you extensive methodology guidance. We have a full curriculum. It's an online curriculum taught in video lectures and case studies. You can do it at your own time. And then we have these kinds of roundtables, but they're private closed-door sessions for the members only, where we actually do the strategic work. We also help you with business development. We have a tremendous Rolodex, and you have access to that entire Rolodex if you're part of the premium program. And we help you with financing, again, in the premium program. We will help you figure out what is your right financing strategy, what collaterals are there, what collaterals are missing, what are the holes that investors are going to get you on. And once you've plugged those holes, then you can go and raise money, and we will introduce you to investors. And we also have a lot of clout in the media, so we do get the word out there about what you're doing. Go to the 1M self-assessment on our blog, on the website, basically, and ask yourself these questions. These are the strategic questions that you need to answer. Every company needs to answer these questions. And these are questions that investors would ask you, but we like it that you ask these questions of yourselves before you go see investors, and try to have a robust set of answers to all the questions. And if you get stuck with methodology gaps, go to 1M1M Basic, which is our curriculum-only option, and plug your methodology gap using the online curriculum. There's a ton of material on the website. You can dig around, look at what to expect from premium, basic, FAQs, video FAQs. The curriculum is described in detail. Curriculum is a case study-based curriculum, whether it's numerous discussions with investors and over 750 discussions with successful entrepreneurs all around the world, a large percentage from Silicon Valley, but also all around the world. you get to stand on the shoulders of people who have done it before successfully, including 50+ unicorns, 400+ venture-funded companies, 300+ bootstrap success stories. You get to stand on the shoulders of people who have done it before successfully, and what they have learned, they have shared very generously, very extensively, and it's very efficient to learn from other people without having to commit every single mistake yourself. Our methodology is lean, capital-efficient bootstrap startups. Even if you raise money, the situation demands today in the market that you have to validate as much as possible. And there's very little appetite amongst investors in companies that have no validation. So that's pretty much it. There are 3 more roundtables in December. This is the last one before Thanksgiving. And we also have an in-person rendezvous on December 13th at Cafe Boroni in Menlo Park, and then there are 2 roundtables, 2 rendezvous, January 3rd and January 10th also in Menlo Park. So people who are looking for in-person meetings, those are great options. Now the line is open. You guys can call in and ask questions or ask questions in the public chat. Happy to answer. Either Ashmeet or I would be happy to take your questions. Harini Sampath, you're asking, the program is primarily for tech, you're a food entrepreneur. The program is probably not going to be useful for you unless online is the primary channel for you. If you're a food entrepreneur selling food in an e-commerce format or doing some sort of a, food business that has a heavy-duty IT component, internet component, then yes. If not, if you're trying to start a restaurant or something like that, that's probably not a good fit for us. Agatya Sinha, general question, when you get an idea in initial stage, you try to figure out whether it's already in the market. If not, then you start working on it. But while your work is already in progress, unluckily similar products get launched in the market, then how to deal with that disappointment and loss? You need to be an adult, look at the data and make decisions and move on. That's how you deal with disappointment and loss. You really need to have a very, very tough constitution to be an entrepreneur. That's just the reality of life.
If it helps you, I would add that there is no entrepreneur who has not failed many times along the way to success. And so you just have to remember that's just the nature of this business.
Soren Sarkar is asking, how does the venture capital world look at family-owned businesses or family members like husband and wife being the entrepreneurs? At one time there was not a lot of appetite in the venture world to fund husband-wife teams. I think that has relaxed quite a bit. We've seen a lot of success stories of husband-wife entrepreneurs or, a couple basically being the driving forces of businesses. So I think the bias has reduced substantially. Look at companies like Medallia, for instance, very successful company, unicorn, Eventbrite, very successful company. These are all run by husband-wife entrepreneur teams. And there are many, many other examples. So, by the way, it was founded by a husband-wife team. Ashmeet?
Yes, I was going to add VMware. My previous company was also founded
VMware, exactly, yes.
Very successful tech company. But the way I would answer the question is that, a husband and wife team is basically one more dimension of risk in a company that when a venture capitalist is evaluating it, they're just looking at it as one more element which exists. And if they can, VCs take a lot of risks. And in the perfect world, there would be no risk, but then there would be no reward either. So that's how I would approach it. It's a
and if you have a good, solid, interesting business that is worth taking that risk, they will take that risk.
Exactly.
So more questions, folks. While you're asking more of your questions, let me also introduce you to Irina Patterson, Irina at 1Mby1M.com. She is your go-to person for all questions about the 1M program that you don't get to ask today and would like to ask in due course. Agatya Sinha again, keeping a unique name of an organization helps it to get identified easily, but common name is easy for advertising. which one should be a better choice. It really depends on the name and what's available, what domains are available. Right now, a lot of the naming is going to depend on what domains you can find. A lot of domains are already taken.
And I would add that it also depends on who your target is. You know, if you're going to be selling in a Spanish-speaking country, you'll think very differently about your name than if you're selling in an English-speaking country. So again, a name is a package deal. It's an all-in-one encompass of your brand, your message that you're going to position for it, who your target market is, how you're going to distribute that name to people. Name may be very important for a consumer company. It may be less important if you have a different path to market. So all ways to think about.
So, Krishna, I assume you are reading the public chat because I see a very pertinent point that Ashmeet has typed in for you there. Whether you're suitable for VC or not, or more generally, what type of investment is the match for your company will depend on whether you're primarily a distribution company selling SIM cards, selling services to end users of SIM cards, or a technology company selling software around IoT. Each of these will result in different types of businesses. That's a very, very accurate assessment of the decision-making process that you need to take your company through.
Fair comments. I've read that. Thank you for that.
You're very welcome. Anybody else? All right, folks, I don't see more questions. We're going to wrap up. Thank you for coming. We will not be here for a couple of weeks, but we will meet you back here very soon, and we will see you on December 7th at the 377th Roundtable. There's a comment from Tish De Zoisa. In London, we're seeing a lot of scale-up businesses raising lots of US-based VC money, but at their core product level, they lose money. Fundamentally, they're giving away their product and continuing people to keep using the product. They ultimately gets them a big database. How come? Well, it's been a trend in venture capital is to, you know, basically use these loss-making unit economics to get scale, and it's not panning out well at all. You'll see we just published an article on the company Blue Apron, which did exactly what you're saying and scaled up hugely, but enormous amounts of loss, terrible unit economics, and now the growth is slowing. They've gone public, and they're getting absolutely hammered in the public market. So these are not the kinds of companies that we believe in. These are not the kinds of strategies that we encourage our entrepreneurs to pursue. So it's good that you're observing this. Our strong recommendation is to steer as clearly away from these strategies as possible. Ashmeet, do you have any comment?
I agree with you at the general level. I mean, just to explain to them, you know, you raise money only if you are losing money. If you were making money, you would not need to raise money. And so the question of the more money you raise, the higher the risk you are taking that you will eventually become a profitable company. But ultimately, the goal of every business must be to become a long-term profitable company. So these are all interim steps that you are seeing, and you are right. Sometimes people never make it to the promised land. They never get to the end goal, but that's the risk they take. And that's when entrepreneurs and VCs lose everything.
And because of the proliferation of these heavily funded companies in the ecosystem, there's a lot of death by overfunding going on. So if this topic interests you, Tish, go to our website and look and do a search in the search box on death by overfunding. And you'll see case study after case study that we've covered of companies imploding after getting these heavily funded situations, and then they can't keep pace with either the growth or the profitability requirements that are the eventual goal of every company. So yes, they get PR, and then eventually they get very bad PR when they start failing. So you know, the problem with the press, and this is a big kind of hot button for me because I've countered them and constantly challenged them on this topic, is that the press is really dumb. Entrepreneurship press loves to cover funding announcements. That is the problem. And, you know, that gets more coverage than anything else in the entrepreneurship press. And that's a disaster, absolutely. It's causing so much harm in the ecosystem that, I could not say more about how bad that is for the health of the ecosystem. Anything else anybody wants to discuss? Right, it's not healthy. You can say that again. All right, folks, thank you very much for coming. Ashmeet, thanks so much for your wonderful contribution and participation in today's session, and look forward to seeing you soon.
Thank you, everyone. Happy Thanksgiving.
Bye-bye.